The second part important is the pace of rate hikes. We still believe that there will be a significant, I would say, concentration or focus on how the growth and inflation dynamics work across. There will be some hit to growth also. I think RBI is still very upbeat on projecting growth.
You mentioned crude is up, rupee is depreciating. How is this holding on to Indian macros? Is our Indian macros holding on? And what impact then therefore it would have on the interest rate scenario within our country? Welcome to Moneynomics by Axis Mutual Fund. I'm Divya Menon, and with me here I have Head of Fixed Income, Mr. Devang Shah. Welcome, Devang. So in today's world, there's a lot that is feeding from global markets into the domestic market. So we'll start off with global perspective. What is your take on the ongoing global turmoil, geopolitical turmoil, and how are central bankers reading into it?
Fair point, Divya. I think probably last 60, 70 odd days now, and we were all discussing this, like probably the event will get over soon. There will be a lot of the truce between the two nations. But I think in the last 70, 80 days, the one biggest important factor which is worrying markets, central banks, us, is the Middle East conflict. And we are not seeing an immediate respite or a closure of this. Though our base case view still continues that both of them are trying to settle along and probably come up with a solution which is, from a medium-term perspective, good for markets and good for all economies. But every day, oil stays above 90. I think what we need to understand is someone is bearing the cost. What has been the good point is all throughout, I think because we had a significant lower inflation regime all across. Not only you spoke about global markets also, there was a significant lower inflation regime. After the tariff issue also, we have not seen a pickup in inflation. Secondly, I think, at least specifically when I come to India, there was a lot of space on government side also because there was fiscal consolidation. So when I look at it from a global market perspective, till now, and there were buffers, till now it has not hit economic activity so much. But our perspective is slowly and gradually, if this continues for long, we are going to see an impact on every economy, and India being a large importer of oil, I think we'll start seeing significant impact on the overall macro sentiment. Be it growth, be it inflation, be it twin deficits, everything we start seeing now. How do we look at it today? I think the world has now started repricing at that crude is going to settle in between $80 to $90. And in the near term, we are not going to see significant fall in crude prices. With that context, definitely rate cut cycles are now gone. And probably we've been talking about it now for 2-3 months. Yeah. Or probably 2-3 quarters, sorry. And we believe so that slowly and gradually, the central banks will tilt towards rate hikes if this continues for long. We've already started seeing noise from ECB. We started seeing Japanese central bank have already started to hike. We believe that Fed is at the cusp. Obviously, there is a change of governorship at Fed, and probably the new governor should take office soon. With that context, we believe that markets were pricing in 2 rate cuts, but now I think at the beginning of the year, now I think markets are not pricing in any kind of rate cuts. So, will that tilt towards rate hike come soon? I think it all depends on how fast this entire conflict settles. But if it prolongs for long, I think let's be ready for rate hikes from central banks.
So, you mentioned crude is up, rupee is depreciating. How is this holding on to Indian macros? Is our Indian macros holding on? And what impact then therefore it would have on the interest rate scenario within our country?
So see, at a margin, macro has deteriorated, and I think we spoke about it in the last outlook also. Where I look across at 2013, 14 and today, if that's a, I think, general comparison which markets have, and if I look across at last 2 years, and let's look at India macro today. We're not in a shock or a dire situation like 2013-14. Let's clarify that. Okay, like 2013-14, everything was in a mess. Current account deficit, fiscal deficit, inflation, growth.
Yeah.
We were in
all
ICU.
Parameters were crossed.
We were in ICU. Is that Indian economy was so in such a bad shape? But when I look at 2022, 23, 24, I think we were in a Goldilocks environment where inflation was after the COVID, we had a huge growth impetus. We had fiscal consolidation. We had lower inflation. We had current account deficit under control. I think at a margin, all of this will get somewhere down the line impacted. With crude at 85-95, a band, I think we believe so that current account deficit will take the biggest hit, and probably it will form a lows of less than 1% of GDP. It will probably move to close to 2%. And the second hit would probably be in inflation. We believe so that there is a possibility that we actually see the retail petrol prices or diesel prices to start seeing increase. And if that happens, Obviously, we don't know, but there's a possibility that it happens because, as I told you, there's a cost being borne either by government
somebody is
or
bearing the cost.
So if that happens, I think somewhere down the line the inflation will also see uptick, and the second half inflation for India can go above 5%. We were all pricing in 4.5 band 6 months back. I think we'll start looking closer to 5 quarter, or probably touch 5 half also. In that context, we believe that the longer this conflict continues, the earlier the rate hike cycle will start.
So next month we have the policy, right?
Yeah, I think next month our view is still that probably RBI will start preparing markets for the change in expectations of rates and everything. Probably they will sound hawkish, but I think the August policy onwards, every policy would be live for rate hikes if this continues for more than 1 month.
So that, essentially brings us to the investor. Markets are volatile, bond yields going up, going down, going up again. So obviously, as an investor, what strategy would you recommend at this juncture?
So Divya, one thing which we also need to guide investors is now volatility is the new way to look at markets, because it is been like every year you have something.
Yeah, it is a norm now.
It's a norm and the new normal. We believe that if you look at the last 3-4 years, we have had the Russia-Ukraine crisis, we had the tariff issues, we had now this Middle East conflict. So markets are going to remain volatile. Now let's understand that where are we on the interest rate cycle. We have been time and again telling that the large part of rate cycle is over. We are probably now moving towards the next scenario, which is the next phase will be either stable rates or rate hikes. This Middle East conflict has actually led to, I would say, the probability of rate hikes, it will get preponed and you'll start seeing rate hikes sooner. The second part important is the pace of rate hikes. We still believe that there will be a significant, I would say, concentration or focus on how the growth and inflation dynamics work across. There will be some hit to growth also. I think RBI is still very upbeat on projecting growth at 6.9% for next year. We believe that obviously April high frequency indicators are very, very strong. But the moment you go into the second quarter and if this continues, I think somewhere down the line you will start seeing the high frequency indicators to be weakened. And with that context, they will play along on the growth inflation dynamics. Our view is that the operative rate can go closer to 6%. And if this conflict continues, I think every policy from August, there is a possibility of a rate hike. What are we suggesting investors then? We believe that investors for the near term should stay invested in the short end of the curve. We've been talking about that accrual is the way to go for the year and probably start focusing only on lowering duration and building accrual in your portfolio. We have done that across all our strategies. We have lowered duration across all our portfolios and somewhere down the line focus on accrual, yield, higher yield and carry as a theme. So we continue to advise clients today that probably focus on these themes in your portfolio. If you'll ask me which strategies investors should focus on, I think till the first rate hike, I'll always advise client to stay invested in the short end of the curve, which is money market, conservative short-term bond funds. Makes a lot of sense in this market environment. Once the rate hikes get delivered, and if it's a shallow rate hike cycle, I think somewhere down the line we'll start probably giving guidance on gilt allocations or some long duration funds. There is a possibility that if this conflict somewhere down the line settles down sooner than all of us are expecting, because we have been talking about it and now it's been 70-80 days, so now there's an overhang that probably markets, the thing will continue for long. But if it actually settles along and crude prices fall below 70, there can be some tactical benefits by allocating to gilt funds today. So how I will position my portfolio, I would say a large portion will be allocated to lower duration, conservative short-term funds at this point of time. And probably once the rate hike starts, start looking at gilt, long duration funds and duration strategies.
So essentially, lower duration to short duration can form part of your core allocation.
Yes.
Okay. Thank you, Devang. Thank you for your insights. Thank you, investors, for watching this space, and stay invested, stay disciplined.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.